Hello, Jason Bates here, owner of Electrum Financial, located right here in beautiful Scottsdale, Arizona, where a mortgage is not a flip of the coin. If you like the lowest rates at the lowest cost, then allow me to put my 30 years of experience to work for you. You've got nothing to lose. Here is this week's mortgage market at a glance. Mortgage rates have been volatile in 2022, to say the least. That volatility has not been friendly to mortgage rates either, except for the past 2 weeks. I will try to shed some light onto why this is happening. And the first thing to consider is inflation. Higher inflation means higher rates. Inflation had been pretty non-existent for the past decade, but it became a headline in 2021 and for most of 2022. Several big jumps in inflation have forced the Federal Reserve to drastically tighten policy. One of those policies had been to buy lots of bonds, including those that specifically underlie the mortgage market. More bond buying demand equal lower rates. As the Fed backs out of bond buying, also known as quantitative easing, rates are hit with a double whammy of high inflation and less bond buying demand. Now, bond traders try to get in front of what they think the Fed might do next, and as a result, mortgage rates surged higher, but by May, it was beginning to look like mortgage rates had finally found their footing and began to level off. That may have proven to be the case if it were not for a duo of hotter than expected inflation reports in the European Union and the United States. The Consumer Price Index, or CPI, was particularly troubling. It happened on June 10th and was responsible for the rapid spike up in 30-year fixed rates up into the sixes and even beyond. Fast forward 3 weeks, and rates are just now back to levels seen on June 10th. Now, the following chart includes the often cited but frequently misleading weekly rate survey from Freddie Mac, in addition to actual daily averages for the top tier 30-year fixed rate quotes. Hashtag volatility. As I said before, bond traders try to anticipate what the Fed may do, and as a result, often overreact to what the Fed actually does. Traders were nervous as they waited to see how the Fed would respond to the June 10th CPI report. Last week's anticipated report was the PCE inflation data, which, along with CPI, is one of the two major inflation indices in the U.S. It came in only slightly cooler than expected. This is all the market needed to feel better about the future. After all, some good news is better than no good news. PCE also showed the third consecutive month of declines. One report you can follow is the PMI, or Purchasing Managers Index data. The XRT chart is an EFT that tracks a broad-based equal-weighted index of stocks in the U.S. retail industry. This is an excellent chart to follow to see how retailers are doing and can give you a good sense of how the overall economy is doing. Most of the PMI data in Europe and the U.S. has been slipping recently. One of the components of the Eurozone report showed the first decline in manufacturing output in more than 2 years. The U.S. version painted a similar picture via the contraction in new orders, which plunged well into the 2-year lows, matching the weakest pre-pandemic levels going back to the financial crisis. The combination of weaker economic data, cooler inflation, and an overreaction to the Fed policy outlook back in June means this could be the top for mortgage rates. Let's hope that's the case. This doesn't mean that rates will continue to fall. It just means that we may have seen the worst for rates, and I will need to see several months of data to confirm inflation is under control before rates really find their footing. Now, the following chart shows market-based inflation expectations in orange. As of this week, they fell back to mid-2021 lows. I don't think that our economy is set up to sustain a high rate environment for a long period of time. And with that said, let's hope the worst of the mortgage rates is behind us. The 2021 lows are still higher than anything since, 2014. Also consider that the orange line represents expectations for the next 10 years, not a forecast for imminent price improvement. Nowhere is that concept more painfully apparent than in home prices. This week's home price data from both FHFA and Case-Shiller showed price growth remaining near 20% year over year. I'm not sure that what data they're seeing to make that case though. There are a couple of things to consider here. The first is that the month-over-month numbers will be increasingly important as economists look for a turning point in prices. Now, the month-over-month numbers are not giving any love, though. The second is that home price indices are notoriously late. Both were released this past Tuesday, June 28th, and they cover the month of April. A lot has happened since then. Some of the drama has been captured in the form of price cuts on real estate listings. Many YouTubers and others that I refer to as clickbaiters are predicting a housing crash, and I'm not seeing that at all, but I also understand that 20% appreciation year over year is not sustainable either. What I believe is happening is that housing is getting back to a normal range. The majority of the price cuts are among sellers who were getting greedy based on the staggering price trajectory of the past 2 years. Price cuts for those fantasy seekers is not only good, it's necessary. We want house price growth to be slow, steady, and sustainable. That will require a sharp contraction in price growth, with some areas seeing modest, and I emphasize modest, contractions, all forwarded by a period of low growth. I understand those who owned homes in 2007 and through 2009 or 2009, but I'm not talking about big, widespread price declines. Just enough of a return to normalcy, which is something that the housing market hasn't seen for a few years. So there you have this week's mortgage market at a glance. If you'd like to know more, reach out to me. I'd like to meet you. Thanks for watching, and if you're looking to purchase or refinance a home in Arizona, I'd like to be your broker of choice. Until next time, take care and stay safe.